Sorry, MattyP. I just wanted to get off the record.
We're on the record now.
Yeah, okay.
Okay.
We need to do a clap.
So my kid, Xander, loves cars. He was asking me like what my favorite car movie was because he's like, I'm pretty sure I like Cars 1. I'm like, oh, that's cool. But I was like, Ford versus Ferrari is pretty good, you know.
Oh.
And then there's a new...
That's got to be one of Jesse's top 10. I'm going to put it out there right now.
When he was asking me, I wanted to ask you because you're a car guy.
I think Ford versus Ferrari is a really great one. Yeah, I don't know if there's a better one. I mean, obviously the F1 movie's coming out. That's really exciting.
Yeah, that's
Fast and Furious. It doesn't get you excited.
Fast and Furious is kind of like a guilty pleasure. But when it came out when I was a kid, yeah, you better believe I loved it.
You were sitting there in the seat.
Yeah, that's back when they were, just a bunch of hoodlums racing souped-up cars, and over time they became like international mercenaries and spies,
agents,
Iron
Man,
running international missions for the government.
It's like
pretty incredible.
The first couple are like the Skittles or the Laffy Taffy, and then the last few are like the filet mignon and the T-bone, and then you know throwing a little, I don't know, European something or other flavor in there.
Yeah, big time.
Yeah, that Formula One movie looks pretty good though.
Yeah, I'm excited.
I hope it turns out well.
It'll be good.
What is going on, everybody? Welcome to the HIG Podcast from the Harris Investment Center in Provo, Utah. I am MattyP, and I'm here with your host, Bronson Kaufusi.
Hey, everybody.
What's going on, Bronson?
Not much. It's a good day.
Did you race any cars this last week?
Did I race any cars?
Any Formula One cars?
Oh, I saw some really nice cars, actually. I don't know what they are. That's why I asked Jesse or take a picture and send it. I don't know the cars, but I've seen a lot of nice cars this week.
You know, it's funny. My youngest son, Xander, he knows more cars than I do. And I think that I'm pretty well educated with cars, right? So we'll be driving down the road and he's like, oh, I call that Bugatti on my team. Oh, I call that Lambo on my team. He knows all the little intricacies, the logo stuff. So he's 8 and he's a car guy already.
I like it.
That's when my love started.
Oh, there you go.
It's gonna blossom. Just you wait.
That's awesome. That's good hobby to have, a good interest. Well, we are happy to have a regular reoccurring guest with us, Jesse Yeats, on the show. Jesse, welcome to the show.
Great to be here.
Here to share investment knowledge, car opinions and knowledge and all of it.
And I like this subject because it's one that I guess came from a question from a listener, which is great to have an episode that's in direct response to a question. So that's great.
Yeah, for sure. So kind of a long story. I'll sum it up. A few months ago, we got a question from Joel Wright. And Joel asked, how can I best become a qualified real estate professional? Now, we've been developing this episode for a number of months, and we had a couple game plans, a few guests that we were going to bring on, and schedules are conflicting and time's short. But today, the stars aligned that we were able to get Jesse, rope him in to come and answer that question and talk about all the benefits that come along with that. So, Joel, this is your episode.
It's a great question, though.
You better like it and share it and tell all your friends.
And it's a question that we hear all the time. Like in all the calls that I'm involved on and other members of the team are involved on, we hear this question a lot.
And we ask that question too.
Yeah, I mean, it's
are you a real estate professional?
Right. Yeah, exactly. It's a big part of what we do. It's a big part of the product that we offer. So, let's get into it.
Yeah, I think it's important. Maybe we talk first about what it is and why it is before we go into how we achieve the real estate professional.
And what it does.
Yes. Yeah. And just as a reminder, you should always talk to your tax professional, of course. But this is very valuable knowledge. I mean, I didn't know about this until I talked to Jason years ago.
Yeah, me as well.
Same?
Yeah,
okay.
None of us are, and nobody in the firm that is part of our corporate payroll are CPA is a CPA. So please consult with your tax advisor. None of this should be construed as tax advice. But we know enough to be dangerous. We obviously are very much involved with the process and talk a lot about it because not only are a lot of the members of the team real estate professionals and utilize that strategy, but I would say maybe 25 to 30% of our investor partner base also utilize this designation and the strategy. And so we've learned enough, and we've talked to hundreds of CPAs over the years. And so we've we've learned enough to be dangerous for sure. So why this even exists, just like any tax incentive, the government wants its populace to behave and do certain things. If the populace can behave in certain ways to help grow the economy, then the easier and better it is for the government. And so the government puts together these incentives and put it into our tax policy with the hope that we will do certain things, right? Now, private housing in America has always been a problem. And the government recognizes, for the most part, that they're not great at the allocation of resources and the execution of initiatives, right? And that's why in most areas they rely kind of on the private sector to get things done. So when it comes to housing, they put together these incentives and or this designation, this incentive. And so what that is it allows folks who are involved in real estate business, and there's certain qualifying activities that count, that they can benefit against in reducing their tax burden, their annual tax burden. And that's kind of the gist of it, I guess, from a 30,000 feet level. So when I say reduce your tax burden, what that means is you're able to recategorize what would be passive losses into active losses. And as active losses can offset active income, like W-2 income, 1099 income,
capital gains,
other types of earned income, which is, especially the first two I mentioned, are taxed at the highest rate. Mm-hmm. So if you can reduce that income, that can be really powerful in reducing your tax liability, right? And so, and with real estate, like any kind of asset or property, we are able to depreciate assets over time. And so if you can buy something, you get this phantom loss, which is depreciation. It's not real loss, but over time it's a loss. You can use that against your income in the year that you buy a piece of property. So now all of a sudden, instead of just a real estate piece of property being an investment vehicle where there's hopefully appreciation and hopefully there's cash flow, maybe it's one or the other or both. In addition to that, you're also reducing your tax liability in the year that you purchase the real estate. So now it's not just an investment vehicle, it's also a tax vehicle. And we love this here because there are so many different tax avoidance strategies out there. I mean, I feel like we've heard them all, and then a week will go by and we'll hear about a new one. Yeah. Dime a dozen. And every one of them is more exotic and unique than the last.
Especially social media. Social media has blown up the tax strategies.
Yeah, and you see people market them and liberally, and it's important to note that what we're talking about today is not one of those strategies. This is not a tax avoidance strategy. This is utilizing depreciation, which is the oldest tax deduction in the book, right? And so we love that because we're just, we're an investment firm, and it just so happens that because the government struggles with real estate, they have real estate incentives in the code. And that allows us, who are real estate investors, to offer not only an investment product that is real estate, a hard asset, which has its benefits, but also couples tax incentive and tax benefits. So, how do you qualify as a real estate professional? Again, surface level, really, really high level. In order to qualify, you need to spend the majority of your time, so greater than 50% of your time, in real estate. Second, in the amount of time is the second rule, and it needs to be at least 750 hours a year, a calendar year. And this is a calendar designation. You would want to qualify on every single year on the calendar year. And so 750 hours, that's like 14, 15 hours a week. That's what that equates to. Yeah, cool. And so again, the minority of our investor base use this, but for those who can, it becomes very, very impactful. Because you're able to shelter that tax liability.
So one thing you brought up there, I think, is a good point I wanted to ask you about. I think people will really, love to know. You said they need to be active in managing their real estate. What types of real estate? Yeah. Like, is there a specific one? How does that work? Because it's like, there's all types of real estate out there. And I think some of our listeners are going to say, okay, I own this type of real estate.
Right.
Yeah. Does it work? Like, yeah. So maybe you could touch on that.
Yeah. So I'll list off what is in the code in terms of the type of activities, the categories. Mm-hmm. But again, the question you just asked, that's a question for your CPA, right? Do I qualify? Or better yet, maybe phrased even better is, how can I qualify?
Like that question.
Because then this is not a knock on CPAs, but going back to what I said earlier, I've talked to hundreds, and some, not all CPAs are created equal. Some are they want to get the job done, and they don't think outside the box and how to maximize the tax return for their client.
And strategize too.
Yeah. And so if you ask the question, do I qualify? They may just, in a very binary way say yes or no. Mm-hmm. Where others are willing to be more creative with you and willing to plan and strategize with you. And so the question could be better phrased, how can I qualify? Mm-hmm. You know my facts, my circumstances, you know my situation here. What do I need to do, or me and my spouse, what do we need to do to qualify? That would help a more proactive CPA to be like, that's a great question, if they hadn't talked about it yet. Like, let's think about this. Do you already qualify, or how close are you to qualifying?
Yeah.
So in terms of the categories, they reference very specific categories of what a qualifying activity is, the type of real estate business. They reference development or redevelopment, construction, reconstruction, acquisition, conversion, operations, and property management. Leasing and, rental activities are part of that. And so those are the types of things. So, maybe it'd be helpful to maybe elaborate on a prototypical example that we see often.
That'd be great.
Again, we see lots of different versions of this, but I would say the most common scenario is, again, this is just most common, okay? Most common, we have a husband and wife.
Made a lot of money.
They're a credit investor. They're looking to work with us. And the one individual is the breadwinner. And most of the time, they're not in real estate. Mm-hmm. Sometimes they are, but most of the time they are not. And then the other individual, who is the non-breadwinner in the family, maybe that person, stays home with kids and raises the kids at home. Maybe that person also doesn't have a full-time job. That person manages real estate properties, their real estate portfolio. And so in this example, this household, most of the time we see a couple who has a couple of real estate properties themselves. They have a couple rentals. They got a duplex. They've got, a couple single family homes or a triplex that they manage.
Maybe house hacking.
Yeah. I mean, maybe they've got a basement rental, right? Yeah. And they have most of the time it's a small portfolio, mm-hmm. but they got a couple rental properties and they self-manage. Mm-hmm. And that allows them to, for one of the spouses to qualify with those two criteria, which was one, the majority of their time is real estate. There's not another job that takes the majority of their time, 50% plus. And they satisfy the 15 hours a week requirement. So again, that's the most common scenario. Again, you could be involved with, acquisition, you could be, a builder, you could, be doing other things, but just simply property management is without a doubt the most common scenario that we see.
Mm-hmm. Everyone listening, remember, why is this so important? Because you either had a really good year, or you had a large liquidity event, and you're trying to play the real estate game that was created to help with your taxes. And so it's so valuable to be able to claim the real estate professional designation. Mm-hmm. And some people already do it.
Yeah. Right? And just to really double down on what you just said, and Jason Harris talks about this, fairly openly. He loves to talk about how little he's able to pay in taxes and how little he's been able to pay, and almost to the point of bragging about it, because it can be a very difficult thing when you're making a good amount of money. But it's a strategy, again, that is perfectly legal. It's in the code. And by the way, you could also make the argument like Tom Wheelwright does, who is Robert Kiyosaki's, is I don't know if he's his current CPA, but he used to be, and that's what kind of made him famous. If you haven't read his book, he's got a couple books, but Tax-Free Wealth is a famous one of his. He talks about, we have heard people say it's your duty as an American to pay taxes.
Yeah, your patriotic duty.
Yeah, and he comes out and says, no, you're more of a patriot if you do what the tax code is incentivizing. It's there for a reason. The government wants you to behave in certain ways. So if you're behaving according to the way the government wants you to, that's more patriotic than anything else. Right. And so, he kind of flips it on its head. And so, we obviously lean into that, or at least folks who can. But yeah, so going back to kind of Jason and others who really lean into the strategy in the fullest, what does it mean? It means this. Every single year, there are investors of ours that we work with who they do everything they can to pay as little taxes as possible. They, generally they're running a business, so they use business losses as part of it, right? They have rental properties. They have their own house, so they're writing off mortgage, business expenses, credits, kind of everything under the sun. But in addition to that, you're not going to get rid of your full tax liability. That will only do so much. Mm-hmm. With this strategy, you're able to kind of go all the way to zero if you wanted to. Now, I understand some people actually don't do that intentionally. Mm-hmm. Even one of, a tax partner that we've worked with quite a bit kind of likes paying a little bit every year because that's just his own opinion. But you're able to go to zero if you wanted to. And so think about it this way. In investing mm-hmm. and in our business, we fight and scrape for every single percent of return. Mm-hmm. Every percent of return counts because we're long-term investors. And in the long run, every percent makes a substantial difference over time when it's compounded, right? Yeah. Right? Oh, yeah. Making 10% versus 12 or 12 versus 15 or 15 versus 18, whatever it might be. I mean, dramatic differences, hundreds of thousands, millions of dollars over the long run. And so the way I like to frame this is while we fight, tooth and nail over these small percentages, mm-hmm. that fighting and those percentages are pennies compared to the level of tax liability you can save every single year. So what we're talking about will move the needle more than anything else you do with your portfolio allocation. And that's a pretty wild and kind of dramatic thing to say, but it's true because we have investor partners. And by the way, they're not only investing with us. Mm-hmm. They're investing.
We're just one option.
Yeah. We're just one private equity firm. They may work with others. They might be doing it themselves, right? But effectively, the way that they look at it is at the end of the year, I can either pay Uncle Sam or I can invest in real estate, thereby growing my real estate portfolio, which will generate a loss and reduce my tax liability so I don't have to pay Uncle Sam. So pay the IRS, grow my wealth portfolio.
Right. Through a program created by the government to incentivize that very action.
Exactly. And so we have investors that save, most are saving hundreds of thousands a year. There are some that are saving 7 figures every single year. And it's incredible. Or more. It's incredible, wow. Right? And so, and again, the minority of our investors do this. Most of our investors invest with us simply because the real estate products that we offer provide a great risk-return profile, right? Great appreciation, great income. But for those who can lean into it and can qualify, it is an absolute game changer. Okay, so I probably harped on that enough.
No, it's great though because it's honestly a mindset shift. That's what I think about when I first heard about it from Jason, is because it's just you just don't know what you don't know, and when you first hear about it, you're like, okay, how does this work? But then what gets exciting is when you understand how the real estate professional can affect your overall wealth and velocity of wealth, and how it can help accelerate it. The next question becomes, okay, where's the strongest depreciation assets, and where are the assets that create depreciation and create cash flow or mm-hmm. income? So I think that's something that there are tiers to it as you go. Because at first, I know people, we all know people here who get into real estate, they buy a rental and they run their first cost seg on it themselves and they're playing at that level, which is great. But then you keep going and you start to see, oh, there's more things that can depreciate and create more value.
Yeah, and that's the unique thing about what we do is specifically, multifamily is fairly common, but triple net lease gas stations and truck stops are a more unique asset type and unique sector. And that's where we play. Half the firm's portfolio today is in that asset type. And that allows for significantly more depreciation. And I know Jason has talked about that on previous episodes about how we're able to generate 100, 200% plus, kind of depending on the year and legislation. And that dwarfs the level of depreciation you can get from a house or from an apartment building. And so, that's a very, very powerful vehicle for depreciation specifically. So in case it wasn't totally clear, would it be helpful if I laid out a scenario where you were to buy an asset of ours?
Yeah.
But one, you weren't a real estate professional, one you were.
Yes. That would be very helpful.
Yes.
Yeah.
So again, I already said it. Most of the folks that work with us do so just for the underlying investment itself. And so in the scenario where someone doesn't qualify as a real estate professional, then it's just like any other investment. There's an appreciation opportunity and potential. There's cash flow opportunity. We'll hold it for a certain term that we expect. And, we, at least with gas stations and truck stops specifically, we're generally looking for a 15 to 20% IRR target range. Sometimes we're okay with less depending on the deal and the operator and the circumstances. But generally that's what we like to see, around 15%. We feel like that's a great return for what you're getting. So that's what you'd get. And then there's a lot of depreciation that comes with it. Regardless of whether you qualify, that loss benefit is going to come to you on a K1 at the end of the year. That's the tax document. And so you're going to get it either way. If you qualify, you're able to use it against active income, but regardless, you're going to get it. But if you don't qualify, that's fine too. You'll get that phantom loss benefit. You can use it against the income, the yield that you get on all the cash flow you get. All that will be effectively tax free because it will shelter it. So that's what it means for someone who's not a qualified real estate professional. They'll get the appreciation just the same, and they'll get a cash flow, and they won't pay taxes on the cash flow because the depreciation will shelter it. It's a passive. The cash flow is a passive income. The depreciation is a passive loss. Passive can offset passive. So that's it.
It's great. Yeah.
Cool.
Now, when you qualify as a real estate professional, all of a sudden the default passive loss is changed to an active loss because you're materially participating in real estate. So you're no longer a passive investor. You are now considered by the government an active real estate investor. And by being an active real estate investor, that loss becomes active. What does that mean? Well, it means that active income can offset active income. And I said this in the beginning, the reason why that's important is because active income, like W-2 income, 1099 income, is taxed at ordinary income rates, the highest tax rates, more than capital gains, right? And if you're gonna look to save money, you want to shelter the highest tax dollars, right? And so qualifying as a real estate professional, you get everything like in the other scenario, right, where they don't qualify, same appreciation, same cash flow. The difference here is that you can use that phantom loss and you can use it against other areas where you've made income, not just the property and its passive cash flow. You can now use it against other types of income that you receive. Maybe you sold a business and you got a big fat capital gain, right?
Common.
Right? Maybe you got 1099 income. Maybe you have W-2 income, whatever it may be. You can shelter that with your real estate depreciation.
That's awesome.
That's right.
Oh,
Really cool.
game changer.
Game changer.
Yeah.
It is truly something that once you understand it and you find a way to, okay, how do I play this game?
Yeah.
Because if you didn't know it, you just don't know it.
Yeah. And we can help out there. We're well versed in this topic. Happy to have a call with anybody who's interested. And we're happy to jump on the call with your CPA too.
Yeah.
And there's a chance your CPA knows all about this and it's a good opportunity. There's also a chance that they don't know because the tax code's huge, and some CPAs don't specialize in real estate, and that's okay. Mm-hmm. But at a minimum, it's important to at least address the question: can we utilize the strategy? Is this something that we can use in our wealth planning? Because the process is a little more nuanced. We're kind of going over this from a high level, but we actually have a document that was prepared by our tax partner who does our fund accounting. They provided they have a lot of expertise in real estate. And so we asked them for a document that we could use and send out. And they said, absolutely, we'll put that together for you. So we actually have a document that lays out step by step how you qualify. And it is more nuanced than just simply, the two criteria that I laid out. But if you can qualify, it can be game changing. So happy to obviously play a role wherever we can there and assist and add value where we can.
That's great. What an incentive laid out for us. If someone wants that list, how do they get that?
If you have a question about this, contact@Harris Investment Group is a great email domain to use. And we'll send you the PDF, and happy to answer any questions and talk to your tax accountant and help out where we can.
So good. Thanks, Jesse. Thanks for coming and sharing about this, just because as we go, people always ask, how do I use the real estate professional designation? How do I rep status? What is that? And it's people are asking that question every day. And so now we can just point them right here to Mr. Jesse Yeats on this podcast, and they can listen to you explain it and provide a lot of value and help everyone play the game, because there's a lot of people that are, using the tax code in its highest form, I guess, or using the rules, playing by the rules in a way that accelerates their wealth. And so it's great that we, here at Harris Investment Group, we can help just answer questions, because we love sitting and talking about this and exploring it. Yeah, because people need to explore it.
There aren't too many areas of the tax code where you can couple investments with tax shelter. Mm-hmm. Another popular one is energy. And so like oil and gas is a really popular, a popular asset class for this. But in your traditional assets, stocks, bonds, and the like, you're not going to see the ability. I mean, short of like tax loss harvesting, there's not much you can do. Yeah. You're very, very limited in how those investments can also benefit your tax situation. And so we just benefit by, just by the fact that the government has put these incentives, and we happen to participate in an asset class that is paired to it. Yeah. But we lean into it heavily. We're obviously all in on being able to generate a 15, 20% type returns. That's what we're gearing for. But for an individual who can utilize this and utilize it this way, and all of a sudden their returns can look like 30, 40%. I can't remember what the numbers are. I've run models to say like, okay, if I'm making X a year and I'm investing this much, I'm trying to get down to zero, what does like my net return really look like? And it obviously inflates everything in a very, very positive way. Yeah. And so no one should invest 100% in one asset class. That includes real estate. You shouldn't let the tax tail wag the investment dog, as we say. But that aside, there's a lot of prudence to coupling investments with tax when it's a viable investment strategy. Why not? If it's a good underlying investment, why not take advantage of the tax benefits that are associated with it? Yeah.
Word.
Oh, so good. Well, you heard Jesse. If you have questions, send us an email. contact@harrisinvestmentgroup.com, and we'll get those questions answered, just like we got that question answered today.
That's right.
Thanks, Jesse.
Absolutely.
Let's Need for Speed on out of here.
Nice. Go drop some cars out of a plane and have that parachute pop out and land it on the freeway.
Wait, is that Cars 2 or is that Need for Speed?
I don't know.
I think it's both.
Could be both.
I hope you find your dad.
He's out there. I'll find him. He's on the island.
He's on the island. The HIG Podcast expresses the views of its participants and may not represent the views of Harris Investment Group. The views discussed are subject to change without notice. The HIG Podcast has no duty or obligation to update the information contained herein. It should not be assumed that past investment performance discussed is an indication of future results. Wherever there is the potential for profit, there is also the potential of loss. This is the very nature of investing. The HIG Podcast and its affiliates do not provide tax, legal, or accounting advice. The information shared on this podcast should not be construed as an offering, advisory service, or investment advice. Consult your own tax, legal, and accounting advisors before engaging in any transaction. This podcast, including the information contained herein, is the sole property of Harris Investment Group and may not be copied, reproduced, republished, or posted in whole or in part without the prior written consent of Harris Investment Group.